Well, good morning, everybody. Thank you guys for coming. How are we doing this morning? Good. Real quickly, I just wanted to introduce myself and then also my business partner, Jordan. My name is Justin White. This is Jordan Keck, and our company name is Advantage Mortgage, and we're really excited to be coming here and getting the opportunity to be able to share a little bit about the home buying process, a little bit about what you guys can do now to even prepare yourself in the future, and be really open for some question and answers. So as you guys are going through this presentation, we're going to try to keep it pretty time sensitive so we can leave some time afterwards for some questions. So if you feel like you have some questions, be thinking about it. We're looking forward to answering those for you. For those on the live stream, in the comments underneath the YouTube video, if you have questions, I'll be monitoring that. So if you have any questions, just type it into the comments, and when the Q&A comes around, we will be getting to those questions. So without further ado, Jordan Keck.
Good morning, and thank you all for being here. It's interesting, the last time I was on this stage was about 10 years ago doing my senior presentation for the business school, and I was probably the most nervous then that I had ever been. I remember a massive pounding headache, sweating a ton, of course, but business suit, so you can't see it as much. And I have to tell you, after 10 years, it's gotten a little bit better. So appreciate you being graceful with me today. This definitely is a little bit out of my element, but I think that the information I'm going to be looking at, as the title says, what I wish I would have learned in school about buying a home and about credit. About 25 states now have financial education requirements in high school, but another half of states don't. I think that there's this realizing need for more education about your finances. We're in school, we're making these decisions to prepare us for the rest of our lives. Everybody here is at Corbin because you believe that this decision is going to help set you up for the rest of your lives, give you opportunities, give you career chances, give you knowledge and connections. But one of the biggest financial decisions you'll ever make is in the process of buying a home. So why isn't that something that we talk about? Well, you as students decided that that is something you wanted to talk about, and that's why I'm here, because you decided this was something important. So I wanted to thank student body and the administration for everybody for making this happen. And as Justin mentioned, there will be some time for questions. I want to make this something that's relevant, something that's valuable that you can take with you, whether or not you plan on buying a home today, in the next 2 years, 10 years down the road. Because the reason why you want to learn about buying a home while you're in school. You're in school, again, to prepare for the future. And the decisions that you make today will have an impact on what your financial options are down the road, as many as 10 and 15 years down the road. A lot of the times over the last 10 years I've been in the industry, people will come to me and ask what options there are, what can they qualify for? And a lot of the times I have to tell them that the decisions that they made with their finances and with their credit 5, 10, 15 years ago is impacting the decisions and the cost of those decisions today. So hopefully you're able to take some of this information and apply it, again, whether or not you're looking at immediately doing anything with that or immediately buying a home. What else? Looking at career choices, I know a few people in this room are considering real estate or some of those options as career choices. Those are also industries that we don't necessarily hear a lot about in school. I can tell you that when I graduated, I had no intention of getting into mortgage. I actually actively tried to get out of the industry for the first 2 years. I fell into it by accident. That's a story for another time. But with it, understanding that within mortgage and real estate and insurance, these industries that may not seem sexy on the outside, there's some incredible opportunities. And being able to be exposed to those and understand that those may be situations or careers that you want to get into. And then lastly as well, we'll talk a little bit more about it, but one of the biggest differences in net worth between renters and homeowners, there's a massive difference between the two. And net worth being the total of your assets minus your liabilities, all of your debts. The average renter has a net worth of about $6,000. The average homeowner, over $250,000. So just having your own home, just owning a home, you read a massive difference in your financial future, not only for you, but for your children. I see a lot of families that at the end of life are given the blessing and the opportunity to decide what they do with their home. Do they leave that to future generations? If you're looking at a retirement plan, one of the best parts of your retirement plan can be having a home that's paid for, because your expenses go down so you don't need as much money to retire. Everybody I've talked to in the last decade, I haven't talked to anybody under 40 years old who planned on Social Security being around for them when they retired. And one of the biggest things people are turning to is real estate, even if it's not in your profession, is looking at having your own home paid off, and more it's becoming culturally acceptable to look at rental properties. Apologize, I'm sorry. It's not COVID. So that's why we're looking at here today. One of the first questions I see is people will come and ask, well, what is it cheaper to buy versus rent? And this is something that's really popular to talk about in the media, because with as many people as are pushing the idea of homeownership and as many benefits as there are, there's this idea that, well, maybe rent is cheaper. Maybe it's a better deal to rent than to buy. Well, when we look at just the monthly payment, some of the times it's true. In fact, in a lot of times that is true. Right now, we see real estate prices going up really very quickly. In the last year, we had over 20% appreciation, meaning home prices went up 20% on average in the United States in 1 year. So if a home was $300,000 at the beginning of the year, it was $360,000 at the end of the year. And at the same time, over the last 90 days, interest rates have been increasing very quickly as well. Now, those payments are going up very quickly on mortgages. Rents, if you've been renting, Oregon's actually the first state in the country for rent control, so your rent can only go up 10% a year roughly. In addition to that, if you own a home, you have to pay for maintenance. You have to pay for repairs. You may not have to do a monthly expense, but if you have to replace a roof that's $20,000 or $30,000 in a 10-year period, averaging that out, you need to start saving for that before it happens. So just from the monthly payment, it may actually be cheaper in a lot of cases to rent than to buy. But is it actually more valuable? So the financial benefits of owning a home, when you're renting, the interest rate that you pay is 100%, right? Everything that you're paying is only going towards giving you a place to stay. There's no other benefits. When you own a home, if you're paying your mortgage, a portion of that mortgage goes towards paying down your principal. And that means it's lowering the balance on the loans that you have, and you own a higher percentage of that home. And that's why after 30 years on most loans, if you've made your minimum payments, you will own it with no mortgage anymore. Now, on a typical mortgage, the amount that goes towards your principal, I'd say an average is between $500 and $800 a month. So even if your payments are the same, if $500 a month on a mortgage goes into your pocket in the forced savings plan, that's something to take into consider as well. In addition to that, with the appreciation, the increase in value you have over time, right? Historically, it's not at 20%. I wouldn't use that as your measurements because that's obviously a phenomenal number if you own a home. But last year, most homes made more money than the people that owned them. The average increase in value of a home last year was about $55,000. So that means as a homeowner, your house gained an extra $55,000 in your net worth by increasing value, plus the difference that you paid down. Now, in 1 year, a lot of people saw that gap, that spread in their net worth increase by over $60,000 or $70,000. 1 year. And that's why there's such a big gap in the net worth between renters and homeowners, is your home is doing a lot of that work for you. So if your house can increase $70,000 of your net worth in 1 year, but the rent, comparable rent is $200 a month more, you tell me which is cheaper. So those are some of the things to consider where, maybe it is a little bit more expensive on a monthly payment basis, but there's a lot more to consider beyond that. And looking at how does the process work? So each of these 5 steps we're going to get into a little bit here, but I want to basically show as a whole, it can be broken down much more simply. If anybody here has ever unfortunately had an illness and went on to WebMD to diagnose it, hopefully you're still in this room. I mean, a lot of times you might have 24 hours to live if you do that. But the same information is out there with the mortgages. If you search up how to buy a home or information about interest rates, you're going to be bombarded with information. Most of it's irrelevant. Most of it's out of date because at the start, all of the factors that contribute into your specific scenario, you can think of it kind of like a Rubik's Cube. Now on the outside, there's only 6 different colors. There's 6 different sides. You think, not that many different options. But for your specific scenario, everything that's different is another shift, another combination. And as you start changing the combinations, you'll see that there's almost an endless amount of scenarios on a single Rubik's Cube with just 6 colors. And the same is true for your situation. Mortgage advice that might have applied as little as a month ago, it's out of date at this point. It's changing so fast. And then you also have to consider your specific situation, where you want to buy, what your credit score is, how much you have for a down payment, are you buying with somebody else, where you want to live, particular state or a particular city. Those can all change the situation so that it makes it very difficult to find information applicable to you without talking to a specific person. So rather than being overwhelmed by all of that and trying to drink out of a fire hose, if you think about it in these 5 stages, it makes it a lot more palatable. So starting off with, the first one would be evaluating your budget and your goals. So here, the first thing I always advise people to do, now, and granted, if I'm advising you to do this, it means you haven't done this step yet in the first place, but it's looking at what is your budget. One of the things I tell all of my clients is that I'm able to tell you what you can qualify for, and that's what you're approved for on a mortgage, what loan options you're able to have, what down payment requirements are, what your monthly payments, your interest rate will look like. But that doesn't tell you what you can afford, because what you can afford, that has to do with what you're comfortable paying every month. And I'm not able to take into account things like your lifestyle, any medical expenses you have, the size of your family, how far away from work you are, and how much you have to travel. Those are things I can't take into account and I don't know about. And so if you go to somebody and ask, hey, how much can I qualify for? That's not the same as what you should afford. And it's really common to see online, you should qualify for 35%, your payment should be 35% of your total income. It's an easy answer to give, but it doesn't take into account all of your nuances. So the only person that can really answer the question of what you can afford and what you should afford is you. If you know that you're going to be stretching yourself, it might not be the right decision. And at the same time, you have to factor in, do you have family members who might be able to help in a situation that you weren't able to make your obligations for the month? That can be something to consider. You might want to be a little bit more risky in that situation than somebody else who doesn't have any family connections, that doesn't have any extra savings in the bank, that's really just stretching everything that they can to try and make this work. Now in 2008, I don't know if you may remember that the crash, the Great Recession, the housing market crash, a lot of that was banks and individuals putting themselves in situations they knew they wouldn't be able to repay. In fact, after 2008, there was even a law that got put into place because it needed to happen. It's called the ability to repay. Because before 2008, banks were not required to verify that you had the ability to repay the loan that they were giving you. We have to make a requirement now because people weren't doing that. So now, when you qualify for a mortgage, we have to verify that you have the ability to repay it. Now, those ratios I find for most people are much higher than what you can actually reasonably afford. So this is something that you want to talk about if you're the only one buying or with somebody else with you, maybe a spouse, maybe a family member, maybe a friend. And next, the price range of homes you're going to be looking at. There are some great tools to be able to look and see what homes are available on the market and what price ranges. They're changing very, very quickly. So if you see homes on the market, let's say a $350,000 home, that might get you a 2-bedroom, maybe a 3-bedroom home. Well, if you need a 4-bedroom, then you know that you're not going to be looking in a $350,000 price range, or whatever the price may be. So if you have an idea of what kind of a price range for the homes that you want in the area that you're looking for, that's going to help prepare you that much more when you're actually on your home search. Because at that point, you know what range you need to be in. Next, the expectation, or the expected time in your home. Sometimes a home might be temporary. You only plan to be there for a year, maybe 2 years. Sometimes you plan to be there forever. If it's a starter home, maybe it's something that you plan to rent out in the future. You're planning on being here for a couple of years. Situation with my first home, I bought my first home, and knew that I wanted to be there for a couple of years, maybe 2-3 years, get established into my career, we started a family, and then eventually we wanted to continue to grow our family. So then the question, do I sell that home, use that money to go towards my next one? Do I keep it as a rental, help generate some passive income? So those are decisions and things you'll want to be able to talk about ahead of time so that you get into a good situation on your first home. And your long-term plan, whether you want to rent it out, whether you want to sell it, if you want to get into real estate and become a full-time investor. You'd be surprised how young you can start. And I'm sure you have a lot of classmates who already own homes. I know when I was here, we had several people who were owning homes, buying, even flipping homes while they were in school. And some of those people ended up getting into real estate as well, or the lending side. So a lot of opportunities. So going into that and knowing, what are your goals? What are you hoping to get out of it? So the next step, this is where you do talk with somebody like myself. Pre-approval is when you're going to talk with a mortgage advisor about what are your options. Now, if you haven't done the first step, by the way, that's still okay. Anytime somebody comes to me, I ask a series of questions and find out where you're at. If you haven't already set your expectations, that's where I come in and make sure that we're on the same page. Because the last thing I want to do is put someone in a situation where I can show that they qualify on paper for a certain amount, but they're not actually able to afford it. So I'll always start with, where do you want your payments to be? And then we'll walk through the situation. What's your credit score look like? What's your down payment look like? What do your debts look like? You have student loans, do you have car loans, credit cards, alimony or child support? These are all things we have to take into account. And at the end of that, you can tell them, well, based on where you want your payments to be, this is the price range that gets you that. Now, maybe you qualify for more, but there are the expectations of let's stay within your comfort zone, unless there are other factors involved that would make you comfortable going for more than that. Next, starting the process. So an official pre-approval, that's essentially the process of evaluating all of your documents, things like your pay stubs, your W-2s, your bank statements, your credit score, and your credit history, and determining what loan programs you qualify for. Now, this isn't officially starting the mortgage process, because you don't have a house yet, so that's why it's the pre-approval and not the actual approval. And so most of the time, someone would come to me and say, hey, I want to get pre-approved. They'd submit an application, review their credit score, and typically within a couple of days, I can tell them, well, you qualify for this type of a loan, this type of a down payment, up to this price. Having those options, they're not required to buy a home. There's no cost to doing it, but at least now they know what they're able to do. And sometimes I'm not able to get somebody a pre-approval. If they need to work on their credit score, I can help guide them through what it looks like to help improve their score to give them more options on the table. Sometimes it's saving up more money for a down payment. Sometimes it's paying down debts. But talking with somebody here doesn't mean that you're obligating yourself. It's really just that next step in preparation, being ready when that time comes. And it's never too early. If this is something that you're interested in, or somebody else, I've had conversations with people probably as many as 2 or 3 years before they were actually ready to buy. Because if you don't know what you don't know, there's nothing you can do to help fix or to prepare for it. So the next step, you're pre-approved. Is beginning a home search. So with your home search, when you're getting pre-approved, your loan advisor, your mortgage advisor is kind of the quarterback of that particular section. When you get into the home search, that's when you're going to be working with a real estate agent most likely. And a real estate agent, they're going to be essentially going through that same process but on the home side, looking at what are your expectations. Do you need a 5,000 square foot home or 500 square foot home? Are you looking at 3-bedroom? Are you looking at 5-bedroom? If you are married, maybe you have kids. I have 2 daughters. We could not make it on a single bathroom. I would be using outside, porta potty in the outside. So once you have your search criteria, maybe schools are important, your real estate agent is going to help begin that home search for you. Now, a few years ago when I was buying my first home, it was more of a buyer's market, which meant that there were more homes available for sale than there were people wanting to buy them. Now, that's not the case. Right now, the market is very much a seller's market. So there's more people wanting to buy homes than there are homes available for sale. So the reality is your real estate agent is going to help prepare you for that reality. And when your home search criteria is put in, they're going to put you on a search. And as soon as a home comes on the market, you'll immediately be notified because you've got maybe 24 to 48 hours to put in an offer, before they've accepted one. The average home right now in the Salem area, once it comes on the market, has an accepted offer within 72 hours, and they've gotten over 12 offers because there are that many people looking to submit offers right now. And now that could change by the time that you look to buy a home. Lord knows it's changed very quickly from the time that I bought my first home. And so your real estate agent is going to help prepare you for the realities, whatever that looks like when you're ready to buy. And then when you are ready, submitting an offer. Right now, the offer is probably going to be longer in the future, but right now the basic contract is 11 pages long. And this is a legally binding contract that has terms on what your offer price is going to be, what your deposit's going to be, your earnest money, just similar to a security deposit on a rental, what your home inspections are going to be like, and how much time you have to negotiate any possible repairs, or if you find a crack in the foundation, is that a deal killer or is the seller willing to fix it? The closing time frame, what type of lending you're going to be using. All of those are terms negotiable as part of your contract that your real estate agent is able to help write up for you. And so looking at putting in an offer, the real estate agent's job, they're kind of a lawyer in a sense in writing that up and making sure it's competitive as possible for you. Now, once your offer gets accepted, you're under contract. So now you have a contract between you as a buyer and the seller of the home to purchase that property if everything goes according to plan. There are a lot of contingencies in that contract to protect you. There's a financing contingency that says if for some reason the loan officer didn't do a great job and now you're not pre-approved anymore, maybe you just got laid off from your job, your financial situation changed and you can't qualify for that loan, it protects you to be able to back out of that contract with certain restrictions. It also protects the seller. Having your earnest money, having a security deposit, that makes sure that they're not wasting their time. So if you decided, you know what, the day before closing, I could close on this home, but I don't want to anymore, they get to keep that. There's a financial ramification to you. And so all of those terms, those have to be fulfilled in order to be able to close on a home. So when you're under contract, you'll start things like your home inspection. So your home inspection is going to be a full report on your home, the foundation, the roof, the mechanical systems, the air conditioning, the water heater, all of those components to make sure you know exactly what you're buying. And your real estate agent typically helps schedule that and put that on the books for you. Next up, negotiations. Let's say that home report comes back and shows, guess what, your home's not perfect. No home is. Even brand new homes still have a lot of issues with them. And so as a buyer, it's up to you then to decide what you're willing to accept. Sometimes you want to request that the seller do some of those repairs. Sometimes you want to request that the seller lower their price or maybe pay for some of your closing costs. Say, I'll deal with that myself, but I do want some financial offset. Other times, right now, very competitive market, you might be willing to accept things as they are, knowing that the seller doesn't have as much leverage, or you don't have as much leverage with the seller to try and ask for some of the things you might have been able to get in a buyer's market. So that's all part of the negotiation process. And there is a period built into your contract where if the repairs, if the things are too large, you're able to back out for that as well within a certain time period. And the appraisal. So the appraisal and the home inspection is going to protect you. The appraisal is what protects the bank. And the appraisal determines the value of the property and makes sure it meets minimum property requirements for the lending process. And those guidelines are put out by government-sponsored enterprises, Fannie Mae and Freddie Mac, if you've heard those terms before. So the appraisal, they're going to go out, they're going to spend a few minutes in the home, but most of what they're looking at are other homes that have sold and determining, is the value that you're paying for it justified? So there could be a number of things that come up there as well. You know, there's about 1,000 ways from start to finish that issues could come up along that way of the process. And that's why you have professionals working with you, a real estate agent, a mortgage advisor. Those people are going to guide you through every single step of that process. And there's a lot to do. And then underwriting. What even is an underwriter? I remember hearing this phrase for the first time and thinking this underwriter is behind a veil somewhere, just super powerful. Oz kind of came to mind. Well, an underwriter is essentially the bank's representative to determine if your file meets the minimum qualifications for approval on the loan. They're the person officially responsible for reviewing it all. An interesting story actually about how an underwriter came to be, It actually goes back to a coffee shop. In 1680, Lloyd's of London, which is now one of the largest insurance companies in the world, used to be a coffee shop. And then a coffee shop was a place for trade, and where you'd have merchants and you'd have sailors and bankers all talking about the coffee trade at the time. Because there was such inherent risk in the process of shipping coffee into other areas, they would share the risk. So bankers would come and they would see on the boards all around coffee shop, Lloyd's of London, the names of different shipping vessels and the details about them. And if they wanted to financially invest and share in some of the profit if it was successful and sharing the risk if it wasn't, they would write their names under the name of each vessel. And so that process of writing under or underwriting, that's where it all started. And so today, that's essentially the same process an underwriter does, is they insure the risk of whatever that investment is going to be. And when a mortgage gets made, it's the bank making a financial investment with a portion of risk. So next up, once the underwriter has given your final approval, you've gotten the pre-approval early in the process, submitted everything that needs to be submitted, the appraisal come back and looks good, then the underwriter will give you the final approval, and that's when you're able to actually close on your home. You'll physically sign the final paperwork with the notary. Up to this point, most things can be docu-signed or e-signed. You'll send your final payment for down payment or any closing costs that you may have. You'll be transferring the deed, getting keys to the home. Now, all of this, when you first start the process, there's a big stack of paperwork, probably 80 to 100 pages. I'm sure by the time that you buy, it's going to be even more than that. And so when you finally sign, you'll have a notary there making sure and walking through again everything that you signed, how it's different from the original paperwork, the estimates that you got up front, making sure that those are finalized, things like your homeowner's insurance, and making sure that you know what your payments are, what your obligations are as a homeowner, and what your rights and responsibilities. One of the biggest things I tell people is definitely make sure to review all your paperwork, know where the money is going, what your payments are, how much money you're going to be spending. But at the end of the day, I'd say 70 out of those 80 pages are boilerplate that basically say if you pay, you stay, and if you don't, you won't. Simple as that. Once all of that happens, that's when it's officially time for your moving day. So, now that that all may or may not be relevant for you in the few coming years and how much of it you retain, we'll see. But at least getting an overview for that process is helpful so that it's not a surprise when it comes around. You can have an idea and look back and go, I think you talked about that one time. But in the meantime now, let's look at what you can actually do now. What is immediately relevant for everybody here? And those are the things that are going to have ramifications for you 10, 5, 15 years down the future. The biggest thing I can recommend, and if you don't do anything else, this is the one thing I'd recommend, is taking care of your credit. And the best way to start, I know some people may not know what their credit score is. If you have a credit score, some people may not. There is a site authorized by the federal government to give you a copy of your credit report free once a year from each of the 3 credit bureaus, Equifax, Experian, and TransUnion. So if you have something to write with or even your phones, this is a time it's okay to go ahead and pull those out, because that website is annualcreditreport.com. So that is annualcreditreport.com. You're not going to get any ads on it. There are a lot of, if you just Google search free credit report, that's not the first thing you want to click on. So annualcreditreport.com, and I'd recommend pull up a free copy of your credit report. You can do it from each credit bureau, 3 credit bureaus one time a year, and see what's there. Sometimes there's information that's not correct that may need to be corrected. Sometimes there's information that you'd forgotten about. I've had a number of times where people had a utility bill. Maybe they didn't return their Comcast equipment from when they switched houses. And if you don't know about it, they can place a collection. And I've seen collections for as little as $12 for a return check at Safeway. I didn't ask questions about how they got in that situation, but they did. So with that, once you know what's on your credit report, then you can take the steps to be able to increase your score, to be able to correct any information that's there, rather than be surprised by it when it comes time to qualify. Because I can tell you that the difference between 20 points could be the difference between qualifying for a mortgage and not qualifying for a mortgage. Or it might be the difference in a different interest rate. So you're going to be paying more the lower your credit score is. So again, annualcreditreport.com, what I'd have to say, 7 times for it to stick in. That's going to be the biggest step that I would say to start. And if you don't have a credit score, there are still mortgages that you can get without one, but it's much easier to do with one. So if you have the ability to start generating a score, maybe having a secured credit card, something like that, that can be a great way to go. Next up, as far as debt. Now, every $100 a month that you pay for your debt, whether it's a credit card minimum payment, whether it's student loan payments, whether it's a car loan, that goes and directly impacts what you're able to qualify for on a mortgage. So for a mortgage, the rough rule of thumb is that every $100 a month you pay in debt lowers what you qualify for by about $20,000. So if you have an $800 a month truck payment, which seems like a lot, but it's not all that uncommon, that lowers what you qualify for by about $160,000. So being able to take care of your debt now will put you in a great spot to have more options down the road when you are looking to buy and qualify. For your income, right? There are a few types of income that do take longer for us to be able to use. Now, by default, there's a lot of information saying that you have to be at your job for 2 years in order to qualify, but that's not true. One of the things you have at your advantage here is once you graduate from school, your time in school counts as employment history. So if you didn't have any time in school, you may need to be at your job or in your industry for 2 years. But if you come out of school and you go into a career field, you may immediately be able to use that income as soon as you get your first paycheck to use that to qualify for a home. Now, whether or not you want to, that goes back to the conversation about what you can afford. But other types, if you're on commission, if you have bonus or overtime, or if you're self-employed, you start up your own company, those are situations that you do want to see a 2-year history of that income before it can be used, and even then it's averaged out. So those are things to keep in mind. You know, a lot of times now, the idea of being a contractor or a gig worker, maybe driving for Uber, or being what's called a 1099 or a sole proprietor, a contractor, those are situations where it's going to take longer. You're going to take a couple of years to use that income to qualify. Whereas if you start in a job that's full-time, maybe it's on a salary, you don't need to have that same waiting period. And then the last thing would be down payment. So the amount of money that you place towards your loan, that's essentially your skin in the game and what allows a lender to feel better about giving you that loan. The more money that you're able to have for a down payment, the more options you can have. But there's a myth out there that says you need to have 20% for your down payment, which simply isn't true. Now, 20% does have some advantages in keeping your payments lower, avoiding something called mortgage insurance, which is essentially extra money you pay for the higher risk of having less than 20% down. But the average down payment that you'd actually need is about 3%. So 3% of whatever the home prices you're looking at, much more doable than 20%. And again, the more money that you have available for down payment, the greater options you'll have along the way. Now, exactly how much you need, that again will depend on the situation, where you want to buy, what your credit score looks like, and what your purchase price is going to be. But I've never heard anybody who bought a house that said that they had too much cash. So the more you have, it insulates you from risk. You're able to pay off debts, you're able to buy furniture for it, and it just makes it that much smoother going into a situation where you have a new obligation, you have a home now. Looking at a market forecast here, one of the biggest questions that I've been getting, because I graduated, Corbin, in 2012, right after, a few years after the Great Recession, we saw a big market crash. Home prices went down massively. Economy, it was a horrible job market. And now we've had an incredibly long market of increased prices, of stock market that's doing well. And there's a lot of fear. I've heard a lot of questions, especially in the most recent years, about what's going to happen. Are we going to run into a situation where home prices crash again? And why would I buy now at what seems like the top of the market? I'll condense it down a little bit here because I actually teach a class on this. It's about an hour to 2 hours long, so I'll condense this down. But I'll say that this time around, it really comes down to the supply and demand. Now, you don't have to be in a business school to know the basic concept of economics is that if you have more supply than you do demand, then prices have to go down until that balances. And if you have more demand than you do supply, like we do right now with houses, then prices have to go up. So I look at what are the things that are going to change supply and demand. In 2008, There were literally dogs getting loans because it was so easy to qualify. People would list the name of their dog on a mortgage application, get qualified for it. And then after the crash, as this is all unwinding, you found a number of people who were either deceased, were dogs, or just not people at all, had gotten mortgages, so it was way, way, way too easy. Ever since 2009, as I mentioned, one of those rules that went into place was the ability to repay. It showed that you had to verify that you do have the ability to repay the loan that you're getting, a number of other loans, so it's become much tighter, much harder to qualify, meaning that now we saw a big wave of foreclosures and short sales, people who couldn't pay those homes, and so those homes went back onto the market. Right now, we're at the lowest levels of default, the lowest level of people not able to make their mortgage payments that we've seen in over 20 years. So we don't have those homes coming onto the market and those people being taken out of buying. We also see that for the last 10 years, there's about a 5.5 million home gap between new family creations and new construction. So building really went on the decline after the crash and hasn't picked up since that time, and we're just now starting to catch up. So there's a number of factors that go into it, but I'll have to say, your dog can't get a loan this time around where they could before. So it looks like if we are going to see any kind of a correction, it's most likely looking like prices will start not to go up as fast. Appreciation at 20% per year, not sustainable, but a normal market's around 3 to 5% appreciation per year. Home prices don't have to go down for us to be having a correction, but the appreciation will slow, and that's actually a good thing. So between those lending restrictions being a lot tighter than they were before, that's going to be a big factor in making sure that we don't see another recession like we did before. And then the Great Resignation right now. Job markets are extremely strong. Everybody sees help wanted signs everywhere. And incomes are at a 40-year high, according to a small business optimism index. Those are all components that make sure that as people are able to pay these mortgages, job market's very strong. If somebody gets laid off or let go, there are opportunities for them to get back into the job market at a very competitive wage and make sure that they're able to pay on those obligations. So this time around, again, long story short, I really don't see the market crashing like it did before. I think because we're so short on supply right now, you're going to see more and more price appreciation. I don't think it's going to go above 20%, but a lot of people are updating their estimates this year from anywhere from 8 to 12%, now increasing those back up between 18 and 20% again. And construction backlogs. D.R. Horton, one of the country's largest home builders, actually stopped taking orders last year because there was so long to be able to get homes completed with labor shortages, material shortages, that they just said, we're not going to take any new orders. We need to get caught up first. And last I heard, they still haven't been taking orders. So we're looking at several years before we're able to even get caught up on the current level of demand, even with prices going up and even with interest rates going up the way that they are. So next, moving in, I want to be able to open up for some questions here. And again, just make this relevant. So whether it's a situation for you individually, whether it's a situation that you're curious about for down the road, want to again open it up and just provide as much value as I can for you. Ultimately, with the goal of empowering you with the tools that you need to take control of your future and never be in a situation where you say, I wish I would have learned this in school. And one other thing, if you have the question, you're probably not the only one. So even if you think it might be a silly question or not worth the time, it's valuable for everybody here. So again, I want to let you know that your questions benefit not just you.
Outstanding. Well, hey, thank you, Jordan, so much. Let's give him a round of applause real quick. And also real quick, wanted to give SGA and also Quinn a round of applause for putting this on. Seriously, it's amazing. In our company, it's amazing how often we get people coming up that don't even know where to start. So to be able to have this information, and I know it's a lot of information, there's a lot of complication to it, but you guys can see it's not like walking into a Walmart and purchasing something off the shelf. There's a lot of regulation with it. So at this point, like I said, if there's anybody that has questions, I've got my phone out for those in the live stream. So if you have questions in there, please feel free to type it in. And if you guys have a question out here, please feel free to raise your hand. I'll give like a half a second here. Does anybody have any questions? All the way in the back, I'll run out here.
What should a target self-employed income for a starter home be?
Great question. What should a target income be for a starter home, self-employed income? Oh, that's an interesting question to answer. Great question. So being self-employed, there are two numbers we're going to look at as far as qualifying. You're going to have your total income, your gross income, but then being self-employed, you have the benefit of getting to claim certain things as expenses or deductions on your taxes. Now, most all of those deductions are going to be subtracted out from your income. So rather than using your total income, we use the net. So that means what your gross is, what your total income is, minus all of your expenses, that's what we're actually able to use on paper. And it's not uncommon, being self-employed, to want to write off as much as possible to lower your tax burden. So I have a lot of clients who maybe, let's say, had $200,000 in total revenue that they brought in for their business, but by the time they have all of their expenses, and maybe even paying employees, the actual bottom line number that we can use might be $30,000 or $40,000. So very different. And then for a starter home right now, the other components to take into account would be, what are your debts? Because if you have an $800 a month car payment, you're going to need a lot more income to qualify than you would if you didn't have any debt. So I'll give you a ballpark because I actually want to answer your question, and I'll make a couple of assumptions. Assuming that we're talking about the bottom line number, the after expenses number, and then also, since we're looking at 2 years, it's going to be the average between the two. So I'll assume that both years are the same or that they're about average. And then again, assuming no debt, assuming a good credit score, I'd say first-time home buyer right now, you're looking at around $300,000, $325,000 for a purchase price as an entry. With that, you're going to be wanting to look at about, I'd say $45,000 a year would be the lowest you could get away with no debts at all, and still be able to qualify for that payment. Obviously, anything extra that you have at that point, whether it's lower credit score, that could impact it. Whether it's more debts, that would require a higher amount of income. But again, assuming no debt, and assuming we're talking about an average after expenses income for 2 years, about $45,000 a year should do it right now. In 10 minutes when the market changes, I'll give you a different answer. Yeah, great question.
Awesome. Is there anybody else that has any questions? Mr. Kyle.
Hello, Jordan, big fan.
Good to see you again.
I have some complaints about your coworker I can talk to you about later. So my question is, what is kind of your recommendation of a good credit score to have when starting that pre-approval process for
Yeah,
home
great
buying?
question. So what's the recommended credit score to have? Ultimately, what I tell most people is that the best credit score for you is the one that gets you what you want. I'd say that most loan options start at about a 600. If you're under 600, there are some programs that may be available, but it's going to be much tighter. You may or may not be able to get it. And so once you're at a 600 or above, typically you have options. The ideal, so the credit score that's going to get you the most options, the best interest rates, about a 740. Now lower than that, it goes in tiers. So every 20 points, it's a different tier. So a 700 up through a 719 is all treated the same. 720 through 739 is going to be treated separately, and then 740 and above even more so. So every tier that you're in makes a difference in what your interest rate's going to be and in what loan programs you'll have available to you. But all that to be said, I'd say 600 I would use as kind of a ballpark minimum. 680 opens up the next big tier, and then 700, 740 and above are those kind of the, hey, we can do something. This is pretty darn good. You have most options, but maybe just not the best interest rate. And then you have all the options and the best interest rates. Yeah, great question. And follow up quickly on that one. So if anybody else does have questions, feel free to raise their hand while Justin comes to you. But another big question is, what if I don't have a credit score? Maybe I go to annualcreditreport.com. Is that 6 times or 7 times now? Anyway, annualcreditreport.com. And I don't have anything there. I have no score. I have no history. What do I do? There are a number of things that you can do. One of which is opening up a credit card that's a secured credit card, meaning that it's basically tied to money you already have in the bank. And if you're paying it off every single month before it's due, you don't actually have to pay any money in interest on it. So you can have a credit card to help build that credit history without needing to pay for it. And then another option you can do is something I like to call credit hacking. Now, if you have a friend, a family member, someone that has a credit card, has built a history, maybe even a parent, they can add you as an authorized user onto that card. And if they report that, and most companies do, they'll report that to your credit history as if you had it the entire time. Now, it'll say you're an authorized user, you're not liable for the expenses on it, but I've had some people do this and go from no credit score at all to an 800 credit score. The highest is 850. So an 800 credit score within the course of about 3 weeks. That's a great, great way to get credit quickly, and that really opens up your options rather than having to build your credit individually for years. Do we have another question?
Do you have any advice or specific examples regarding potentially building your own home?
Yeah, advice or potential examples on building your own home. Yeah, great one. So when building your own home, there are a couple ways that you can go. The first one is if you are actually physically building your own home and you want to be the one putting it together. Another was having a builder build the home for you. I'll kind of address both of those because don't know which way you're going to go, and that could change between now and then. So if you're going to be building your own home, it will be a little tighter to get financing for that because it's riskier. Most banks will require that you have your contractor's license or your CCB license with experience to be able to show you know what you're doing. Because if the bank's going to give you money to do that, they want to make sure at the end of it, if they're using your house as collateral, they don't want to just have a pile of lumber left over they can't do anything with. So most of the time, it's going to be required that there's a separate builder who's the one building for you. Strictly speaking, the mortgages are going to look fairly similar, but because not as many lenders do loans to do construction loans to build a home than just a straight purchase one, they might have tighter requirements on what your credit score has to be and tighter requirements on what your down payment has to be. And the down payment's going to be based on the total price of the land, if you're buying it, and the total price to build the home plus a cushion. So let's say if the land is $200,000 and it costs $300,000 to build, total of $500,000, then that's basically what you consider your purchase price, and your down payment would be as a percentage of that purchase price. 10% is pretty common, but there are some options for less than that. So in that particular case, you want to have about $50,000 for a down payment based on that price. And your credit score, again, 600 probably isn't going to get you a construction loan. Maybe 640, 680, depending on the banks you go to. But it definitely is a more involved process. So qualifying for it, again, is one thing. But the biggest piece of advice that I'd give people on when you're buying a home to build yourself or when you're building your first home is I don't typically recommend it for first-time buyers. And the reason for that is when you get to choose everything about your home, if you've never owned your own home before, there are certain dynamics that just aren't quite the same. Once you're living in a place, you have an idea about what you like, what you don't like about it. If you're married, I can tell you that the importance of a second sink in my bathroom really went up after I was married. If I was building a home before I was married, I probably wouldn't have put that in there. And so once you own your own home, you find out those things, then you can incorporate those things that you like and don't like into your next home that you build. There's a lot of moving pieces. It's a very, very stressful process. It always takes longer and costs more than you think that it will. Even if you give yourself a buffer, it'll take longer and cost more. And if you're prepared for that, if all of that doesn't scare you away, then you're ready. But you want to make sure you go in with the right expectations, just because there are so many moving pieces. And I'd say you want to be more prepared than you think that you should be for that. And then with all that, once it's all done, it'll seem extraordinarily worth it in the same way that my wife says it was worth it to give birth after the fact. So take that and do with it what you will.
All right, we got a couple more questions here. One actually on the live stream from Max. Thank you, Max. Consider this situation. Excellent credit, 740 score, full-time student, no job experience. What's available in this situation?
Good advice. Good advice is what's available. So the question is, full-time student, no job experience, great credit score, what's available? So in situations like that, we do need to show income to have the ability to repay. And so that income doesn't have to be from you, though. Now, don't take that too far. if you have somebody who's willing to co-sign for you, and maybe a family member, mother, father, uncle, aunt, brother, sister, doesn't matter. If you have a family member who's willing to co-sign for you, and that means they put their name onto the mortgage as well, they basically combine all of their income, their credit, their debts into the mix. And I had a situation with a gal who was graduating from school and expected to get several job offers very soon and knew that she could make the payments, but she didn't have the income at the time. Very similar situation. Now, in her situation, her parents were willing to co-sign for her, and that allowed her to qualify for a mortgage with her name on the mortgage as well as theirs. And then because she got a job very shortly after, she was able to make those payments, but the bank knew the co-signers were there as a backup if need be. So that could be one route where you're looking at somebody else's income on top of yours because your credit score is good. And then the job history component, another issue is if you are getting out of school and then very quickly going into a job, if you're working full time, we can look and ballpark what your income might be in that situation and look at what your options would be once you get into the job force. Because again, you don't have to be there for 2 years. So having your school history, no debt, little or no debt, again, it doesn't take a ton of income to be able to qualify for some options. So good question. Hopefully that helps. And I hope I'm looking at the camera. That would be really awkward if I wasn't.
I think you are.
Yeah, maybe time for one more question.
Yeah, one more question just for those. It's 10:51, so if those that have an 11 o'clock class, you feel free, you can take off. But one last question here.
For buying a home with a spouse, let's see, I would assume that it would be based off of like being approved based off of both credit scores. How does that work? Maybe if one person had a good credit score, one person didn't have a credit score, or they had good and bad, or maybe both good. What's the nuance there?
Yeah, absolutely. So basically, yeah, I know we got married and all, but do I really want you on the loan? So when getting a car loan, most of the time you can use one person as your primary, and then their credit score is used, but the other person's isn't. Unfortunately, with a mortgage, it's the most strict qualifying process, so we use both credit scores and we look at whoever has the lowest of the two. So if you have an 800 and your spouse has a 600, or maybe we use the other way around. You have the 600, they have the 8. Then we would use the 600 credit score for qualifying and for determining your options. We're not able to average them out. But we have to use the credit score if we're going to be using your income. So in situations like that, assuming both spouses are working and one spouse has a better credit score than the other, I would look to see if they can qualify just based on the income from the one spouse with a better credit score to be able to get a better interest rate and more options. It's not always the case, but that is how we look at it and how I'd say, hey, if we weren't able to qualify or it wasn't the best rate we could get, what can we do to either improve that credit score or qualify just with a spouse who does have that better score? Great question. And with that, I do want to make sure that you all have some time to get to class, so thank you so much for coming. I'll be sticking around a little bit if there are any other questions or anybody wants to chat. But again, thank you all for having us in and being able to share this information for you. So appreciate it.
Thanks, guys.